Congratulations for taking ownership of your financial plan by tuning into the Federal Employee Financial Planning Podcast, hosted by Mason & Associates, financial advisors with over 3 decades of experience serving you.
You will rest easy once your plan is done. You will see clearly just how you have won. Gone are the times where you'd hope and pray. It's gonna be a bright, sunshiny day.
Welcome to the Federal Employee Financial Planning Podcast, hosted by Michael Mason, Certified Financial Planner, John Mason, Certified Financial Planner, Tommy Blackburn, Certified Financial Planner, and CPA, Certified Public Accountant. Mason & Associates have over 30 years of experience helping federal employees in their financial planning. This podcast, we had such a good time, John, Tommy, doing investment jargon, and we had Jeff Hybiak from SEM Wealth Management, Chief Investment Officer. We wanted to do effectively another part of investment jargon.
Yeah, Jeff, we're excited to have you back this will be the 3rd recording that we've done at our office in Newport News. And thank you and SEM for making the time to be here and be a part of the show.
Yeah, glad to be here. And, just a plug for you guys, I think for somebody who doesn't speak the jargon of federal employee retirements, your podcast is great because there's a lot of acronyms in there that I think most of us have no idea what they mean.
Well, Jeff, thank you. And if you're listening to this episode, welcome back. This is going to be Investment Jargon Part 2. We'll probably fine-tune that title a little bit as we get closer to releasing it. If you missed Part 1, we'd encourage you to go back and listen to that one first, because this is going to be a building block as we move into this Investment Jargon episode. And one of the things that we talked about last time, guys, and just bringing it back to our audience is jargon's important for us as the professional to do a good job. But when we're meeting with clients, we don't want our audience thinking that this is how we have client meetings. Like, jargon is not a part of strategic planning meetings at Mason & Associates. And Tommy, I think you said it really well last time. One, the compliments that we receive, and then the Mike Masonism.
Right. So when someone tells us you broke that down in a way that was easy to understand, very digestible, that's music to our ears. And the saying that Mike Mason coined is, we speak your language so you don't have to speak ours. And that is the goal, is to make it so it's understandable to you. You don't have to learn a new foreign language. But if you're curious about those foreign languages, we're going to try to shed some light on it today.
That's right. And a neat update as well as we launch into this episode for our audience is that the YouTube channel is live and active. I think we've been talking about launching that YouTube channel for the last few episodes now, but it's live. We've got some episodes discussing federal employees group life insurance. We have the first 2 parts of our seminar, Avoid the Common Financial Planning Mistakes Made by Federal Employees. So we plan on releasing those weekly or bi-weekly, similar, coinciding with our podcast, similar content but different. So if you like what you hear on this type of medium, we really think you'll like those YouTube videos as well. So make sure you check that out, like, subscribe, hit the bell notification so that you get notified as we release new content. And then disclaimer, we're financial planners first, and we do this second. So we spend most of our time doing servicing our active clients, and that's really where our passion is Tommy, we had a meeting the other day, and this is a tangent alert, and we went around the table on an offsite, and we talked about what is it that we do at Mason & Associates, and I think we got to a really good place, because what we do is not comprehensive financial planning. What is it that we do at Mason & Associates?
Well, from my perspective, and understand this is 36 years into a career, is we change lives. I mean, we want to understand your goals. We want to help you reach those goals and then fulfill. When you say you want to travel, we say to our clients, when you get on the plane, which way do you turn?
We want them to turn left.
You turn left, right? We want you to travel the right way. We want you to travel early in retirement. None of us are blessed to know when our last day on this planet's going to be. So we want to help you change your lives, reach those goals, help you maximize those pensions, but really meet all your life. You don't get any mulligans in this, guys. This is one time around.
Wouldn't a mulligan be another piece of jargon?
Jeff, you're right. I mean, and if our listeners don't play golf, a mulligan is a do-over. It's like, let's pretend that previous shot didn't happen. And to Mike, your point, there are some decisions that people make that are irreversible, irrevocable decisions.
Absolutely. Survivor benefits is one of those, right?
Survivor benefits is one of those, unless it's 2023 and there's a military survivor benefit open season. Stay tuned for that.
Literal act of Congress.
Literal act of Congress. As we dive into this, I just want to say that comprehensive financial planning is such a silly word, or silly grouping of words. It's not what we do, and it doesn't encompass what any good financial planning team actually does. We empower, we educate, we motivate, we help people do things that they wouldn't have otherwise done. We give them confidence to retire. That's what we do at Mason & Associates. And we do that first, and we do this content creation second. So thank you to our audience for being with us. Guys, investment jargon, I think where we kick off this episode, if y'all are okay with it, is let's define what the market is first, because you should buy the market, or we're invested in the stock market.
Or the market went down 1,000 points today. The world's ending. What are we talking about when we say these things?
Yeah, I mean, absolutely. It's literally my biggest pet peeve as somebody. And I started investing before I joined the industry, and decided this is what I wanted to do. Even back then, it was kind of a pet peeve when people would talk, "Oh, the market was up 100 points." Well, what in the world did that mean? So as I started looking into it, I said, "Are you kidding me?" Most people, when they talk about the market, they're programmed to think the Dow. And if you look at the Dow, that's 30 stocks. I think Standard & Poor's ended up buying them, or somebody else, but it used to be literally the editorial board of the Wall Street Journal would sit around and say, what are the 30 stocks we think represents our economy? And then back then, because they didn't have sophisticated computers to calculate it, they did this very simple average of, we're going to take the prices of all these stocks and we're going to add them up. Well, what they didn't realize is if a stock was worth $200 and another stock was worth $20, the one worth $200 had 10 times the impact on the Dow or the market as everything else. So when somebody comes up to me and says, "Oh, the market was up 1,000 points," I said, "Well, what was the S&P 500 up?" Because that's transitioning. So the Dow is 30 stocks based on the prices. So the highest price has the biggest impact. To me, it means nothing, because you'll see like Apple might skew the Dow higher one day and Goldman Sachs down the next. They also change it with hindsight. Up until 2001, there was no tech stocks in the Dow. And then almost at the peak of the market, they decided to add Microsoft and Intel. Well, one would argue that Microsoft and Intel were probably the two biggest components to economic growth in the 1990s. Well, the editorial board did not add them until after that decade was over.
That's convenient. Wonderful. We missed out. So if we were following the Dow, if that's what we were tracking, we missed out on the two largest parts of the economy.
Yeah, absolutely. So it's fun to say, but please don't quote the Dow. If you want to see me angry, quote the Dow to me.
Oh, it makes no sense. And even arguably, we talked on the last episode, Jeff, when you were here, that even buying the S&P 500 is not buying you diversification, because you are overwhelmingly overweight tech stocks right now. So that used to be Apple, Amazon, Facebook, Google. These companies overwhelmingly make up the S&P 500 and account for a lot of its return. So just buying the S&P doesn't buy you diversification either. Maybe something more appropriate would be the total stock market index. Or maybe when you hear the market is down, we need to ask, what market are we talking about? Are we talking about Europe and Asia? Are we talking about the bond market? Are we talking about the crypto market? Are we talking about tech stocks? Like, what market?
And before we extrapolate it to our own situation, right? Because that's usually what we're doing is we see, the market moved this, that way, the other way. And then we think, well, what did that do to me and my investments in my portfolio? And the thing is your portfolio is probably nothing like what is being quoted right now. Those things being quoted may be a component of your portfolio, but chances are, if you're, going into retirement, you've got some bonds in there, and you've got bonds that aren't just the aggregate bond. You've got things that could be shorter in term. You may have, what we'll talk about later, some high yield bonds. even on the stock side, do we have small caps, mid caps? Do we have international, as you said? So realize that just what's being put on TV doesn't really reflect what your individual customized portfolio situation is. That's kind of where we're getting on this soapbox here and saying we got to put these things in context and understand what they mean, and then how do they translate to your situation.
I've got some jargon that you guys wouldn't think is jargon, so maybe it's a little bit of my humor, but plummets. What does plummets mean? Yeah, it's
plummets.
Like plummets, right?
It might be 0.5%.
Right. So the media tells you, like, I'm going to make Jeff mad and use the Dow. The Dow's, let's say, 33,000 points right now. Well, if it's right now, I looked, it's down 500. If it makes 1,000 down, the media is going to say it plummets. But you know what? What was the word for it when it was down 1,000 March 1st of 2000? When it was 11,000 points, they still use plummets. I don't even know what plummets means.
And your point is to maybe, let's put it in percentageal context, right? So 1,000 points today isn't what 1,000 points on the Dow, as we go back to it, what it was 20 years ago, because that number's grown so much. So looking at the marginal change of the index we're tracking is probably more important than just the raw points that are being quoted.
That's like fear mongering, right? It's like, what are we even talking about here? And we know that nasty sells, whether it be social media nasty or the stock market plummets nasty, like that sells. And it's the worst thing our clients can do, or the listeners of this podcast, is to listen to that. And like we talked about on the last episode, was remember, if you're invested for 40 or 50 years, you're in a bull market. You're in a good market for 40 or 50 years. There may be some hiccups in between, but let's not lose sight of the long-term picture just because we're in a shorter term, relatively experience. So much good stuff here. Where do we go next, Tommy?
Well, I wanted to maybe go a little bit further, which is we mentioned the total stock market. And I'm just thinking, I know there's a couple of those even out there, right? Because you have like the total U.S. stock market, then you could have the total world stock market. Jeff, I don't know if there's any flavor you want to add to that, and then I think we move on.
Yeah, I was just going to tag onto that, along with the fear mongering of the headlines, or the upside headlines that people see. It can really taint somebody's view of how their portfolio is doing. For an easy example, in 2022, the Dow was the best performing index of the popular ones. Well, you look at it, and that's because they had a heavier exposure to oil stocks. And John, you mentioned how tech stocks has become such a big part of the S&P 500. Oil to start 2022 was only like 3%. Because of the tremendous returns of energy companies in 2022 relative to everybody else. I think it's now 7.5% going into 2023. So that can taint your viewpoints on that. And so same way, the way we look at it is, if a true diversified portfolio, you can't own just large cap stocks. You have to have some medium company and some small companies. And so, yeah, there's a few total stock market indices out there. Vanguard tends to be the most popular one. They have an index fund to track it. They also just show you the benchmark. To us, that's more important because that represents the U.S. economy is representative of more than just large companies. Now, they're going to track close. I think that correlation, so the way the small cap market moves is about 90% of what the large stock market moves. So I tried to correct my jargon.
I'm having a little fun. So what's a large cap? Is that the stocks with the biggest hats?
Okay. Large capitalization, our largest companies. I guess it's funny, we do use a lot more jargon than we think.
It's almost impossible to avoid it. And Jeff, as you were speaking about the various components of a portfolio, it just made me think a good call to action here is 2022 was not a fun year, and 2023 isn't really shaping up to be a fun year either. And we know investing is emotional. We know financial planning is emotional. And for our audience and for our clients, if they're comparing themselves directly to the S&P 500 or comparing themselves to the Dow, undoubtedly they have some negative experiences and negative thought process. And I thought that's where you were going to go, is that if you compare yourself to these arbitrary indexes, you're going to be unhappy more often than you're happy, right? Because if you have a 50% stock and 50% bond portfolio, and you compare yourself to the S&P 500, you're going to be very unhappy 7 out of 10 years because the market goes up 7 out of 10 times and you're not going to beat the market. So it's important, and I think we do a good job, and I know you do at SEM, of setting appropriate benchmarks to evaluate your success. You know how we evaluate success? Making sure you don't run out of money before you die. That's really the only thing we care about.
Well, that's almost like the table stakes to the plan, right? Is that we never run out of money. But then Mike had mentioned earlier on the intro is taking those vacations, turning left when we get on the plane. And I'm just thinking about a recent experience with a client here to hopefully further your point is they're getting ready to retire. And you just said, we went through 2022. It wasn't the funnest year from a portfolio standpoint. 2023 doesn't feel like it's really fun at this point either from an investment standpoint. But giving them the confidence that they could retire, I think is what it was all about. And it was pretty fun to me and neat. They said when we first met with you, you said, hey, we can take trips of $10,000 per year in retirement. We're getting ready to retire. You still think that's possible. And it just is almost, you wanted to chuckle as you're looking at their plan and how great the plans are we build for our clients here. Because undoubtedly, yes, you can still do that. And if you want, you could double the number, was the message I sent to them. If you want to do 20,000 trips a year, I'm going to have a hard time convincing you to spend that money. But that is how great your plan is, the shape it's in, even after everything you went through. So that, again, is people are seeing things on TV and trying to translate it to their situation. And the reality is their plan didn't change.
Well, it's a great story. And then you probably followed that up. And I don't mean to take away anything from your great story, because that's what we do. Empower, educate, motivate, encourage. And then did you finish that and say, your moderate portfolio should do this, over time. So maybe we dive into some of those terms, Tommy, like moderate, Mike, conservative, Jeff, aggressive. Like what are we talking about when we just throw out these names for things?
Yeah, that's a really good point. I think Mike and we have almost the same number of years experience. He might have a few more on me. But those terms have meant different things throughout our careers, right, Mike? I mean, moderate 20 years ago is different than moderate today.
Yeah, absolutely. And asset preservation, pre-2008, asset preservation, what did you think was going to happen in a down market? If that's the fund you bought, you thought your assets were going to be preserved, right? And they were down 20 to 25% because they had a bunch of mortgage-backed securities that could never go wrong, could they?
Yeah, and I saw one that literally had the name low risk lose 90%.
Unbelievable.
That feels like low risk then.
Yeah, and it comes down to, John, you mentioned it on part one of you got to dig into what they actually own. And as to Mike's point, this fund, they thought they were low risk because they were, I won't even throw the jargon out there, they were playing in the derivatives market, which is a very risky thing to do. That's all you need to know about that.
So as we think about moderate, right? Like we meet with clients all the time, been doing this for decades. Everybody wants to be moderate. Do you know why everybody wants to be moderate? This goes back to probably some life insurance training that Mike, had back in the late 80s, early 90s. But it's like, Mr. and Mrs. Jones, we have 3 options for a life insurance policy. You can have a $500,000, $1 million, or a 1.5. Which one do you think they're going to pick? They're going to pick the one in the middle because they don't want to be too high and they don't want to be too low. So we know that people want to be moderate because it seems like it's in the middle. It seems logical. Did you know, or I'm asking our audience now because I know we all know this. Did you know, audience, that in a moderate portfolio, we should expect to lose 20, 25, maybe even as much as 30%? Is that moderate for you? Because if that's not your moderate, maybe that's your aggressive. Well, or conversely, maybe that's your conservative. But what is moderate and is that your moderate, I guess, is the point.
Well, and I think it's great to, one, let's define what do we mean by that, but then also, why do we care? Well, we care because of the financial plan. So maybe you are moderate. Maybe you can be down 30% because we've got a long-term plan, cash flow plan here. So that's, to me, like, one, let's understand what we're talking, like, what do we mean when we say conservative or moderate? But then why do we care? Well, we care really that this investment strategy matches the financial plan, not by what namesake is assigned to the portfolio strategy.
Yeah, and we're spending a good amount of time, and we should on this. If you have a good financial planner, they're going to help your portfolio get where it needs to get. So, John, your point is if you're doing this on your own, or you don't have a good financial planning team, and you look for moderate mutual funds with 5 stars, you're going to have to dig a little deeper to know what your downside is.
And you're going to own, just looking at that, you're going to own anywhere from 70% of your portfolio in the stock market, all the way down to 30 or 35% is what I've seen. So moderate means different things at every fund company or every ETF. So yeah, if you're on your own, you got to be very careful, because moderate A is not going to be the same as moderate B.
And I guess maybe that takes us into the final segment, is we bring in target date mutual funds. And as we bring up the target date mutual funds, we're specifically talking TSP lifecycle funds, or if you're private sector listening to this, the Vanguard 2035 or the Fidelity Freedom 2040. So what are we talking about in these funds? Well, guys, the target date funds are set to adjust every year. And if you're going to retire in 2040, you should be in the 2040 fund, hypothetically. And that's going to guide you with the appropriate set of stocks and bonds. Jeff will pose this question to you. Do all target date funds look the same? And then what do you think individual investors perceive their allocation to be when they actually reach 2040?
Yeah, I think 2 things is each target date fund is set by a committee of that fund provider. And the other thing that I know Mike and I have picked up on, the target date funds from even 10 years ago had a lot more bonds in them for every year than they did at the start of last year. And that's because they felt like bonds were a drag on the portfolio because interest rates were so low. So they not only do they look different from provider to provider, but what you own has shifted over the years inside of those funds. And if you talk to most people, if they're in the target for 2040, they truly believe when they get to 2040, they're going to have basically no exposure to the stock market.
And we know that that's not true, because that terminal allocation is probably still 30 to 40% equity?
Yeah, I've seen lately, again, because bond yields were so low, now maybe they'll shift it now after bond yields are back higher again, but they were looking at 30 to 35% on average in a retirement portfolio.
And people just don't think that that's happening. They think if I'm in this 2040, by the time I get there, some magic is going to happen. Somebody's going to preserve my losses. And if you pull back the curtain on this, you may still be in a moderate portfolio and you thought you were in some retirement stable value fund.
And because this is the Federal Employee Financial Planning Podcast, and we all know what happens to the 2040 fund in 2040.
That's the income fund, right?
Right. And that's going to be a 20% equity, 80% bond portfolio. I think you ought to mix in, if you've got target date TD over here, well, you need another TD on the right, and that's target death. So if you're going to retire in 2040, but you're not going to die until 2080, shouldn't we be somewhere between 2040 and 2080?
And well, to your point, Mike, I mean, we've had this conversation with folks for decades now. It's like, are you what's the plan after you retire? And if you're a federal employee retiring at 57 years old, do you really want to be 30% stocks for the next 40 years? Probably not. So the L Income or the Vanguard retirement fund, when those things, these allocations are nothing more than a guideline. It's better than sitting in cash. It's better than, let's face it, most individual investors trying to change their funds every year. They're better off on autopilot, to be frank. But the allocation is arbitrary.
It's not customized to you in your situation, right?
It's not solving for anything. It's just arbitrary. And I can't say even more than if you're 57 years old and you're in the L Income fund, that's a long time to only have 20% exposure or 30% exposure to the U.S. and international stock markets.
Yeah, I mean, like you said, especially for government employees, but if there's anybody who has, a 403B or 401k, it depends on what the money's used for. They might not ever touch that money, so why would you want to be all bonds or fixed income? And what we always tell people is work with a planner and create your own target date fund, because everybody's different. You can't just use a one-size-fits-all. And then I'll let you guys finish. But John, you had a name for these portfolios, and we still are supposed to do a research report on it. What did you call them?
The stupid portfolios.
And why is that?
Because in a declining market, they're rebalancing all the time. So, for example, what's happening is we're selling stocks in a declining market. Because why? Well, my 2040 fund needed to get more conservative the following year. So even though stocks were down last year, guess what happened to all those target date funds? Or those stupid funds or those not smart funds? What they did is they sold stocks and bought more bonds when the stocks were down. Maybe last year that wasn't too bad because stocks and bonds were both down. But again, it's just arbitrary selling and arbitrary buying that doesn't align with the financial plan.
Yep. Versus, and I'll let Tommy or Mike do this one. If we, and we'll use our own jargon, if we had clients in the Mason moderate portfolio because that made sense with their plan, what would happen if the stock market was down 20% and the bond market was up next year?
Well, we're gonna sell high and buy low, right? So what we're gonna do is we're gonna rebalance back to that target allocation. We're gonna reduce the bonds that had appreciated and increase the stock side of the portfolio again. So rebalancing can be a very nice part of a strategy that I guess makes sense as to why that strategy is in place.
Yep. So copyright pending, the not stupid portfolios.
The not stupid portfolios. Well,
John, remember, just to add a little bit to this, you named them the stupid portfolios.
So again, to be clear, the not stupid portfolios basically mean target date funds are going to arbitrarily sell stocks and buy more bonds every year as you get closer to that terminal date, 2030, 2040. That means if the stock market goes down, that doesn't matter. They're going to sell stocks. Conversely, the not stupid portfolio would be thinking, my bonds are up, my stocks are down, I should rebalance to a risk objective that is actually solving for something. Me not running out of money before I die, not an arbitrary allocation developed by XYZ board of directors. So there's a big difference between target date and customized. Guys, I think we transition to action items as we close out this episode. What are the big things that we think our audience should take away from Investment Jargon Part 2?
I think the biggest thing is don't just take things at the kind of the cover of the book, so to speak. Realize that just they can call these funds and these strategies whatever they want to. You need to, if you're doing this on your own, understand what's happening under it and does that actually make sense for you. I'll just piggyback and say, we all hinted at it earlier, is your investment strategy needs to be coordinated with your financial plan, and maybe going it alone isn't the best way to do this. So having a qualified professional help you connect all the pieces.
And my main thing is the market, whatever they define it on the social media, is not your portfolio.
Yeah, I would say, know when it's your prices. These are not your prices in 2022. Most of you that's listening to this are federal employees with great pensions that have had effectively a 15% pay raise over the last 2 years on your largest asset. Uncle Sam has just increased for a big part of the investing world your RMD to age 75. So, John, if you retired at 60 as a federal employee and you thought you had a 10-year horizon before your money was forced out, now you have a 15-year horizon before it's forced out. And if you are in that L income portfolio and you only have 20% exposure to stock, now you've got it for the next 15 years before Uncle Sam is going to make you use your money. So I would just say understand your prices, understand your plan, and if the people you're working with are using jargon that you don't understand, and they tell you that your plan is based on 1,000 Monte Carlo theories, many people are thinking that you're at a table in France, playing cards, right?
Well, I love that. You should be working with a financial planning team that you're leaving that experience feeling educated and empowered and motivated to take some sort of action, whatever it may be. And if you're leaving appointments confused, and I'm not going to say our clients have never left an appointment confused, because they have, but generally speaking, empowered, motivated, educated to do something valuable, to take an action, to do something. I think if people are not receiving that from the folks they're working with, we hope they know that there's other alternatives out there, and it doesn't have to be us. I love what you said. Maybe calling back to some other episodes, if you're a federal employee and your plan is to retire and not do anything for 15 years as it relates to your tax plan, that's a bad plan. We should be looking at Roth conversions or something in that 15-year gap. My closing thoughts on this are, it is ridiculous to think that investing and retirement planning is unemotional. It is. We try to take as much emotion out of it as we can, but in fact, it is emotional. It's hard to watch your funds go up and down. Remember, these short-term bull markets, these short-term bear markets, really what we're looking at, we believe, over the next 40 or 50 years of your retirement journey, you're in a bull market. Don't compare, as Jeff, you said, your portfolio to the S&P 500. Find the appropriate benchmark, because we don't want you to be disappointed when you're actually winning. Folks, this is the Mason & Associates Federal Employee Financial Planning Podcast. Thank you for being here. Thank you for being a part of our community. If you have any questions, you can send those to Mason FP. That's like Mason Financial Planning at masonllc.net. And if you'd like to become a client, we encourage you to check out the YouTube channel to learn more about us, or our podcast episode on the Mason & Associates client experience. You can find all of that at masonllc.net.
You will rest easy once your plan is done. You will see clearly just how you have won.
The topics discussed on this podcast represent our best understanding of federal benefits and are for informational and educational purposes only, and should not be construed as investment, financial planning, or other professional advice. We encourage you to consult with the Office of Personnel Management and one or more professional advisors before taking any action based on the information presented.